Today we'll be talking about depreciation. Here's an example. A business purchases office equipment for $12,000 on January 1st. The cash account is decreased by $12,000 as they paid for it with cash. The fixed asset account named equipment is increased by $12,000. The equipment is used up as time passes and becomes an expense to the business. The expense is spread out over the life of the equipment. It is estimated that the life of this equipment is 5 years. A part of the cost of the equipment should be assigned to each year's operation. This is consistent with the matching principle. There is a cost of using a fixed asset during an accounting period to produce revenue for that period. The cost should be recorded as an expense on the income statement for the accounting period. This allocation of the cost of a fixed asset to the fiscal period in which it is used is called depreciation. The process is also called amortization. There is an assumption that the equipment is worthless after the estimated lifetime and that there is no scrap value or trade-in value. When an asset has been depreciated for 100% of the value, no further depreciation is allowed. The cost of depreciation of fixed assets is recorded in the depreciation expense account. This expense is recorded on the income statement. The entry to record the depreciation at the end of the year is as follows. Notice that the date is December 31st for the current year. The debit account is named depreciation expense, and then we indicate equipment. And in this example, it is $2,400. The credit account is accumulated depreciation for equipment, and it's a credit amount of $2,400. The explanation is to record depreciation for the year or the accounting period. Let's talk about the depreciation expense for this particular equipment. It appears on the income statement as any other expense. Notice we don't have any revenue or other expenses for this example, but this depreciation expense for equipment is written underneath the expense section as an expense with all the others, and it is a debit amount. Let's take a look at the accumulated depreciation in equipment as it appears on the balance sheet in the fixed assets section as follows. So we have a partial balance sheet and we have the fixed assets section. Notice that we've included the equipment asset of $12,000, and then we write less accumulated depreciation for the equipment, in this case $2,400, and then we have a total fixed assets of the difference between $12,000 and $2,400, which is $9,600. The accumulated depreciation account is also called a valuation account because it is used to arrive at a value of an asset. It is also known as a contra asset account because it has a credit balance rather than a debit balance found in most asset accounts. Contra means against or opposite, so this type of account is opposite the normal type of asset account, whereas they have debit balances. This type of contra asset account has a credit balance, which is opposite to the norm. A contra account offsets the value of another account, another asset account. Let's talk about book value. The cost of an asset minus the accumulated depreciation is called the book value or net balance sheet value. It is the difference between the original price of the equipment in this example less the accumulated depreciation over time. In this example that you see on the screen, $12,000 minus $2,400 gives us $9,600 book value. Let's talk about book value. It's important to note that the equipment account is the original cost of the equipment. The accumulated depreciation account accumulates each year until it equals the equipment. The difference between the original cost and the depreciation, the book value, is not the value of the equipment. It is just the remaining amount to be depreciated. Methods of calculating depreciation. There are several methods for calculating depreciation. We will be studying two of these methods. The first one is the straight line method. The second one is the declining balance method with a fixed percentage. The straight line method is described in this chart below. In our example, the equipment depreciated at 20% per year, or $2,400 per year. The calculation in the chart shows in year 1, 20% times $12,000, which was the original price, gives us a depreciation expense of $2,400. The first year accumulated depreciation account has a value of $2,400. In year 2, we use the same calculation, 20% of $12,000, which is again $2,400, in the depreciation expense account. The accumulated depreciation account increases by that $2,400 and becomes $4,800. This continues in year 3, 4, and 5, and you'll notice that the accumulated depreciation increases from $4,800 to $7,200 to $9,600, and finally in year 5 it's $12,000, which is the full amount of the equipment. The straight line method says that this same amount will be deducted at the end of each fiscal period. The declining balance method with a fixed percentage is different. Some might suggest that the depreciation of equipment is greatest during the first few fiscal periods of an asset's life. The declining balance method with a fixed percentage method allocates a greater amount of depreciation during the first few fiscal years. As the asset becomes older, the depreciation amount becomes smaller. The cost of the asset is never completely written off as long as the asset is being used. Each year's depreciation is progressively smaller. Let's take a look at the depreciation schedule for equipment using the declining balance method. In the first year, everything looks the same as it did using the straight line method. The undepreciated cost at the beginning is $12,000. The amount of depreciation at 20% is still that $2,400, which is 20% of $12,000. The difference between $12,000 and $2,400 is $9,600, which is the declining balance for the end of the first year. This looks the same as it did using the straight line method. The difference comes in year 2. We take the declining balance end of year amount from year 1, which was $9,600. This becomes the undepreciated cost left. This is $9,600. The amount of depreciation at 20% is 20% of $9,600. This is $1,920 for year 2. We subtract $1,920 from the undepreciated cost of $9,600, which leaves us a declining balance at the end of year 2 of $7,680. This amount is transferred to the beginning of year 3, and we do the calculations for year 3, 4, 5, and so on and so on. And you'll notice that the declining balance at the end of each year reduces less from year to year. The journal entries for the declining balance method are as follows. We are going to take a look in this example at a year of 2001 and 2002. For 2001, the depreciation expense is $2,400. The accumulated depreciation is $2,400. And we're recording the depreciation for the first year. In year 2, the depreciation expense is $1,920, which we saw previously on the schedule. The accumulated depreciation for equipment is $1,920, and this is to record the depreciation for the second year. In Canada, the declining balance method must be used. This method is called capital cost allowance under the Income Tax Act. The maximum rate of depreciation, or capital cost allowance, and the method used is controlled by the government. Different types of assets are grouped into classes, and a maximum rate of depreciation is set for each class. Here is a chart that shows the capital cost allowance for different types of assets. Notice that they have class numbers, there's a description of the asset, and then depending on how long the expected lifetime is, a maximum rate for the calculations. So buildings of brick, stone, and cement are depreciated at 5%. Buildings of frame, log, stucco, galvanized, or corrugated iron are 10%. Machinery and equipment 20%. Trucks, tractors, automobiles, trailers, buses, and wagons are 30%. It is important to note that land is not depreciable. Land has unlimited life, and it does not wear out or deteriorate. It's important to note also that except for a few special items such as farming and fishing assets acquired before 1972, the straight line method may not be used for income tax purposes. Due to circumstances, businesses may choose to not use depreciation for a given year. If a business knows that it will not be profitable for 1 year, it makes no sense to use depreciation to help reduce the net income, and therefore reduce their income tax. Businesses can choose to save this year's depreciation for a year when the business is profitable, and the depreciation will help to reduce the net income at that time. Businesses may keep 2 sets of accounting records. The business may feel that the straight line method is better for the business and will keep a set of books using this method. By law, the government insists that the declining balance method is used for income tax purposes, so the business will keep a separate set of books for income tax. This is absolutely legal. As long as they use the right set of books for the right purpose, it's allowed by the government. Now we need to talk about a couple of new principles. The first one is the principle of materiality. This principle requires that information that could affect the decisions of the users of financial statements be included when the financial statements are prepared. If the accountant has knowledge that certain conditions apply that can affect the financial statements, they must be reflected in the financial statements. An example of this is if the accountant knows that a customer will never be able to pay an accounts receivable account, this must be indicated on the financial statements as soon as that information is known. The second principle is the principle of conservatism. This requires that when there is acceptable alternative accounting treatments for an item, accountants choose the one that will result in the lower net income and lower net assets. This is called applying a conservative philosophy to the accounting process. Your assignment is to complete questions 5 to 13 on page 217 in your textbook. These questions can be answered on our website. And in your workbooks, complete exercises 3 to 6. The questions can be found in your textbook on page 218. Also, case studies 1, 3, and 5 must be completed. They are found on page 265 in your textbook. You can answer these questions, these case studies, on our internet website.